All right, Andrew, we're starting to do a lot more valuations currently. One of the real common valuation discussions we're having, the population's getting a little older. Folks are starting to look to retire and move on to the next phase of life. Succession planning is a real big discussion point that we have with a lot of clients, and how is their appropriate exit strategy from their business. Obviously, a lot of clients have a significant amount, if not the majority of their wealth built up in their company. And so when it's time to move on, how do they reap those rewards from all those years of service? So talk to us a little bit about some of the exit strategies that a business owner may have.
Yeah, so one of the best places to look for succession planning is internally. Does the business have any family members that would be interested in buying in, or does the owner want to gift some ownership to the company to some family members? In both cases, a valuation would be needed to kind of set that value. For gift tax purposes, you actually have to have a full valuation for what the IRS calls adequate disclosure. If there aren't any family members, the business owner can ask themselves, are there any longtime employees or key employees that may be wanting to buy in? Again, a valuation would be used to set that fair price so that the business owner gets rewarded for their hard work, and the key employee buying in gets a fair price as well.
So obviously, if we don't have an internal option, we would look for an external option there. External option is either going to be an investment broker or another company looking for a strategic strike. These companies oftentimes do a lot of these deals, and so a business owner knowing the value of the company and us being able to provide a valuation engagement to give them some foreknowledge about what that value is, puts them in a position of strength in the negotiation with those companies or individuals. So Andrew, if we've got a client that's looking for this succession plan, obviously this is not something that they want to do at the spur of a moment, or just something they can make happen within a couple of weeks or a couple of months even. What's the typical timeline we see on a client and recommendation you'd give if they're starting looking at their exit strategy right now?
Yeah, so in these situations, time is your friend. We typically recommend 5 to 10 years prior to retirement. We need to start looking at that. A lot of cases, what we see, if we do have that internal buyer, a family member that wants to buy in, a lot of times what they'll want to do is buy in over a period of time. So we always recommend go ahead and identifying that now so that we have those options available to us.
Yeah, and even in the same case with an external buyer, obviously if we're doing a valuation or a calculation to figure out their value, a buyer is going to come and look in at typically a 5-year preceding window of their operations and performance. And so knowing how that's calculated and what all affects those numbers can really give the buyer a position of strength and make sure that when that time does come, that they truly are getting the best value for their company by cleaning up some of those things that they can increase the value with. So yeah, if we have a client that's starting to have these thoughts and discussions, feel free to give us a call. We'd love to chat with you and talk through these issues. Again, the sooner the better, as Andrew mentioned. Time is on our side. Earlier the better.